Good morning. Welcome to the 20th annual NYU KPMG Tax Symposium. My name is Britt Haxton. I'm an international tax principal with KPMG, and I'm joined by my partner, Stephen Ehrlich, who is my co-host for today's Tax Summit.
Welcome, everyone. Welcome to the recently renovated lounge. Happy to be here for our 20th, although 5 years have gone by, symposium. The theme of this year's symposium is tax disruption, the tax policy trifecta. Trifecta in the sense that there is a confluence of three impending disruptors that will impact the Fortune 500 and beyond. Our trifecta is comprised of three prongs: the 2025 tax cliff resulting from the expiration of many of the provisions of the 2017 Tax Cuts and Jobs Act, global tax reform, not just Pillar 2, but what else may be coming down the pike, and what we have broadly bucketed as regulatory changes, everything from the recently released proposed CAMT regulations to ongoing daily tariff developments and the evolution of judicial interpretation of administrative regulations. Today's program will endeavor to forecast the future tax landscape in light of these disruptions. But before we begin, a few administrative notes. First, no food or drink is allowed in the auditorium. Breakfast, lunch, and mid-morning and mid-afternoon snacks will be served across the way in the Greenberg Lounge, where the symposium is also being telecast live. Additional seating for lunch is being held upstairs in the Snow Dining Room on the 4th floor, as well as outside in the courtyard if you prefer. The panelists will be taking questions, but we ask that you hold your questions until the end of the panel. Approximately 10 minutes before the panel ends, we'll be opening up for questions, and people will be coming down the aisles with mics to assist with that.
And because I know everyone's really excited about this part, there will be 4 hours of CLE and CPE credit available. Just make sure that you sign in at the beginning. And if you're looking for CLE credit, make sure you sign out on the way out as well. Before we kick off our first panel, I'd like to welcome to the stage Dean Troy McKenzie, who is the Dean and Cecilia Gutz Professor of Law at NYU School of Law. Thank you, Dean.
Thank you. Good morning, everyone. It is a pleasure to be here this morning. This began as a lecture on current issues in taxation back in the fall of 2000. And this started with Steve Brescher and Larry Pollack of KPMG as the driving forces. I understand that they're both here today, and I want to recognize them and thank them for their pivotal role in creating this event. Over time, what began as a lecture matured into a symposium that explores the most pressing issues in federal taxation. We ran through 2019. There was a symposium planned for April of 2020. And for reasons that are not disclosed in my notes, that didn't happen. I think that page must be missing. And so we are really, really delighted, however, to relaunch this series this year as the 20th. This is a part of our intellectual community at NYU, and of course, an important part of our tax program. We are very fortunate to partner with the leaders of the tax practice at KPMG, including Danielle Rolfes, partner in charge of the Washington National Tax Practice, Britt Haxton, international tax partner, and Stephen Ehrlich, who is a principal in the business tax services practice of KPMG. And I want to thank all of them for their incredible work in pulling this together. And I also want to recognize our very own Professor Brant Helwig, faculty director of our graduate tax program, and John Stevens, its director. The success of this program and of our graduate tax program are, of course, linked. I am also extremely grateful for the investment that KPMG has made in this series and in our graduate tax program in selecting us to host this wonderful event. It's wonderful to look around this room and see so much firepower and horsepower together. I want to express our appreciation at NYU for the scholarly approach that is always taken in these circles to the types of topics that we're going to discuss and analyze today. It is now my privilege to introduce someone whose leadership is central to this event, Danielle Rolfes, partner in charge of KPMG's Washington National Tax Practice. I was told the shorthand for the practice, and I've forgotten what that shorthand is. It is the technical core. That's right. I should have written that down. Danielle brings vast experience to bear on some of the most consequential matters of international tax policy and practice. She advises multinational clients on tax implications of their structures, operations, and transactions. And before joining KPMG, she was International Tax Counsel at Treasury, where she played a leading role in shaping tax regulations and treaty policy, and also played a role as part of the group representing the U.S. in critical global negotiations. Danielle, thank you for your leadership and for your partnership, and it is really a privilege now to hand things over to you.
Well, it is my, whoa, that's loud. We're thrilled to be here. KPMG is thrilled to have the opportunity to partner with NYU to sponsor this event. Let's not let another break like that happen. I've spoken to so many of you this morning about how excited you are to have this event come back. I think we had over 500 registrations. There's an overflow room. For those in the overflow room, we've got a lot of open seats in the main room, so you're welcome to join us in the main auditorium. No food or drinks, I think. Well, it's certainly an interesting time to be hosting this symposium. I was listening to you, Dean, and thinking, there's so much disruption in the tax world, but I also wouldn't want to be the dean of a law school right now either. So maybe we're not a special tax, we'll talk about tax exceptionalism in the last panel, where we talk about all the regulatory disruption and what does Loper-Bright mean for our tax regulations, but maybe tax is not so singularly disrupted, but it certainly has already been an incredibly disruptive year with the three forces that we're facing into around global reform. What is happening? I mean, we had a delegation we're still having the multilateral framework discussions, a delegation to the OECD to try to talk about how are they going to sort out Pillar 2. I don't know, I heard a promise that we were going to forecast the future here. I'm afraid this might be a little bit disappointing from that standpoint. We have all of the regulatory disruption. Stephen didn't mention the disruption to the IRS, our enforcement agency, and how many of our friends have been disrupted and disrespected, frankly. And then, of course, on the legislative landscape, they don't have it yet. As of this morning, they don't have a resolution yet. So it's just so much disruption, and it's only April. I will just close by thanking Stephen and Britt and the whole KPMG team that has pulled this together. I will admit there were a few times that Stephen or Britt sent me an email, and I was like, oh my God, not again. You have been working on this tirelessly for months to pull it together, and I think you pulled it off. But the KPMG events planning team and marketing team, just an extraordinary job. And I know all of the little details. I was picking on the flowers. I said, we got blue and purple, but there's more purple than blue. And Britt, I triggered her, and she goes, not the flower. And and then it was pointed out to me, KPMG is now purple. So it's such a symbiotic relationship that we have here. Okay, Britt, I know you want your panels to start on time. I will get off the stage. There are open seats in the main room, so we'd love to see them filled. And I think we're gonna have a great program. Thank you.
All All right, without further ado, I'll welcome our first panel to the stage. And while they're coming up here, I'll start introductions. For our first panel discussion today, it's titled The 2025 Tax Cliff, and we will explore the TCJA expiry, which represents the most significant tax legislative challenge since the TCJA's enactment in 2017. And no matter whether this crisis is averted or we do in fact go over the cliff, the consequences for businesses will be significant. This panel will be moderated by my friend John Gimigliano. He's the principal in charge of our federal legislative regulatory services at KPMG's Washington National Tax Practice. John was senior tax counsel for the Committee on Ways and Means and staff director for the subcommittee on select revenue measures. He's an adjunct professor at my alma mater, Georgetown University Law Center. And as I'm sure everyone knows, he hosts the KPMG Tax Podcast, Catching Up on Capitol Hill. Joining this panel, we have immediately to John's left is Professor David Kamen. He's a professor of law at NYU School of Law, focusing on budget and tax policy. He served as deputy assistant to the president and deputy director of the National Economic Council under President Biden, and he held key roles in presidential transitions and the Obama administration. Professor Kamen also worked at the Committee for Economic Development and the Center on Budget and Budget and Policy Priorities, focusing on budget projections, tax legislation, and Social Security reform. We are very grateful for your insights today, Professor. We're also joined then to Kamen's left is Professor Barbara Angus, who's Barbara Angus is a consultant with Ernst & Young, and she previously served as EY's global tax policy leader. From 2016 to 2018, she was the chief tax counsel for the House Committee on Ways and Means, playing a key role in the Tax Cuts and Jobs Act of 2017. And then to her left, we have Jennifer Acuna, who's the co-principal in charge of the Federal Legislative and Regulatory Services at KPMG's W&T practice. Before joining KPMG in 2019, she served as chief tax counsel and senior tax counsel and policy advisor for the U.S. Senate Committee on Finance, where she was the lead drafter of the Tax Cuts and Jobs Act. And with that, I'll turn it over to you and go get a glass of water. Thank you.
Okay, thank you, Britt. Good morning, everybody. Thrilled to be here on this stage. And what we have here, if it's not apparent, are protagonists from the largest two tax bills we've had in the last, I don't know, probably back to 86, really. I mean, if you think about the Build Back Better, and of course how that ended, but there were important lessons to be learned from there. I think the Republicans should be paying attention and learning lessons from there, as well as the Tax Cuts and Jobs Act. So Barbara in the House, Jen, you in the Senate. So that's what we want to talk about today. We, I think, decided this is not a will they or won't they, kind of legislative update. There's plenty of those out there. You'll find those. What we really wanted to talk about is not will they or won't they, but should they is a really interesting question. And how should they? And then also talk a little bit, I know it sounds so boring, about the process and the budgeting for this bill, but really, I think as we talk about it, you'll understand that it will dictate so many of the policy choices that Congress is going to be forced into as they continue to negotiate this tax bill, that it's really, I think, will help us understand why they do what they do or not do as we go through this process. So thank you, panelists, for joining us. Look, I'm going to ask, before we jump in, I want to ask this alternate history question. Here we are in 2025, wondering what Congress will do. But let's just look back to 2017 for a moment. And the question is this, look, obviously the Tax Cuts and Jobs Act was somewhat controversial when enacted. It was quite a process to get enacted. If we had not enacted it in 2017, would we be forced to do so in 2025? Or would it have been necessary to do so in 2021? In other words, can you imagine a world in which we still had the 2017 tax law in place at this point? What would that look like? So let me ask you, Barbara, let me ask you, do you think it wouldn't have been possible, would it, to maintain the old 35% rate and the old structure all this time?
I can't imagine having a world where today we still had a 35% corporate tax rate and rates on flow-through businesses and sole proprietorships that were up at 39%. I can't imagine that. So it would not have been exactly TCJ if it had been in a different year, but we had to do something.
Okay, David, do you agree?
I think that there were elements of the prior tax system that have been left seriously unstable by prior actions of Congress. The international system being the one that I think all parties agreed was actually at that point unsustainable. We could have a long discussion about what would have happened if Congress hadn't done the one-time repatriation holiday back in the early 2000s, which then led to an expectation that there'd be further and then the buildup of unrepatriated profits. But whatever the diagnosis is, that system was not working. And so Obama had proposed a one-time tax on unrepatriated profits and a shift to a new system. The Republicans as well were working on that. However, I think the 2017 law is not just that. And we could discuss the details of international reform and elements we would agree on and disagree on. But it is also a significantly revenue-losing bill that loses about over a percent of GDP in revenue in an environment in which the government was already not bringing in enough revenue to meet commitments. So can I imagine an alternative in which it didn't happen? Yes. And I, in fact, think looking ahead, we need to either face continued uncertainty about what the policy environment will look like, or policymakers will need to come to a set of decisions about how to make that math work. This makes it work less. And so can I imagine an alternative where it didn't happen? Yes, because in fact, we're going to need more decisions that go in the opposite direction.
Do you think that Build Back Better was a better depiction of what you think a better solution to that would have been? You know, the changes that it would have proposed in the international world?
So in the international world, yes. But I do think it was in some ways building on the model created under the TCJA, though obviously taking it in a somewhat different direction in the way of the minimum tax on foreign profits. Then we can have detail. I know a future panel will be discussing country by country and so on. And I think that there were elements of that I think would have been important and good reforms. But I also want to say what it didn't do. The Build Back Better in all its various iterations, I think, was responsible in the sense that it was paid for over the long term. And if the IRS money had continued, for instance, may even in the IRA have reduced the deficit somewhat over the long term. But what it didn't do, and what we will eventually need, is either a set of reforms that I'd probably disagree with, but would make the math work, that would reduce the spending side of the ledger, or we will need a serious set of discussions around a tax system that is sufficient for our government. I think that is possible. We have had versions of it that would be a lot closer, but we're right now going in the wrong direction.
Okay. Well, Jen, let me bring you in here. So, of course, we've got the 2025 tax cliff, as the Hill is calling it. You know, I don't think we're calling it tax reform. Some people are insisting, right? Some people are insisting on calling it reform. Look, it's in the eye of the beholder, of course. I'm not sure that's a pure extension of current law would not probably be that. But let me ask you about these extensions. So you know, a lot of blood, sweat, and tears into the 2017 law. Of those expiring provisions for, depending on how one accounts for it, $4 or $5 trillion worth, are they all worth extending in your view?
Well, I mean, I think that you typically, when you consider a bill, you consider it, you know, policy on a permanent basis. So a lot of the tax cliff, I think, is very much, you know, in play. I mean, I think there are legitimate reasons for those provisions being in there. The individual rate cuts, the doubling of the standard deduction, you know, the pass-through rate relief for small businesses, you know, the GILTI rate, FDII benefit, the beat rates. These are all things that were just carefully designed and carefully calibrated. So I think that, you know, when we first put those together, we were putting it together as permanent policy, right? And because of the rules of reconciliation, which is a very budgetary-driven exercise, that's what kind of led to these cliffs. If I had to make a plug for something that really should not be extended, personally, I'd say the state and local tax limitation.
Yeah.
Ha, please listen.
Everybody applaud.
Thank
This
you.
is our chance.
Thank you. But there are reasons for that as well. You know, that's a budget-driven exercise. So, you know, that's an area where they had to marry, you know, we had to marry policy with budgetary constraints and the need to offset a significant portion of the bill. And it did that.
Well, Barbara and Jen, just because you were there in 2017, let me ask a very practical question. This is an interesting conversation. Should they all be extended? Should they not? In the real world, does it matter? Because is the political consensus built around all of them being extended? Is that a practical reality, no matter what the policy might say?
I think it is a practical reality. The the TCJ, particularly the individual side of TCJ, was the product of many years, years of thinking and many months of very detailed work, and it was a balance. There were a lot of provisions that a lot of members didn't like, but they didn't like different provisions. And in the end, they were able to come to consensus on the combination. They took some things that they didn't like because there were other things that they really liked. And if you started to open it up at this point, in April of 25, and you need to get it done by the end of the year, and you have a Congress that includes many members that weren't involved in the process before, I don't see how you get there.
Yeah. How do you feel? Do you think that we should toss some of these overboard and move on without them?
Yes.
Yes.
So I both want to, discuss some of the things that I actually think that the bill did, which was good, but then discuss what I think was really deleterious to the tax system, and also a symptom of a dynamic in our politics that I think will need to change looking ahead, and we're seeing evidence right now of the kind of instability that this dynamic has created. So on the good, to start on the good, and I think there was good here, and frankly good that politicians that I tend to work with may not have been able to do, though I wish the revenue had been put to other purposes. The changes, for instance, on the home mortgage interest deduction were not just an offset. That was I believe, a good reform that actually improves efficiency, is also fair. The changes when it comes to the increase in the standard deduction and the swap of that for the elimination of personal exemptions. The child tax credit, though I think that should be made fully refundable and offered to lower income families. These were good things. The limitation on expenditures when it comes to entertainment. These are good reforms. However, in bulk, the bill was a money-losing bill with provisions that a number of which made no sense whatsoever. We talk about the small business deduction. It's a deduction 199 Cap A, where we call it small. It is called sometimes labeled small business, but of course it is passed through entities, many of which are quite large. 50% of the tax benefits going to those making over $1 million a year, with a set of complicated eligibility provisions, which it's hard to say that looks like great tax policy making. And I understand how politics can, turn things around, but those are the kinds of provisions that we shouldn't be enacting. And then in terms of the net of this bill, it is a bill that loses over 1% of GDP in revenue, where the percent change in after-tax income for the top 1% is 3 times that for the middle quintile. And there are trade-offs. There are trade-offs in government. They happen over time. And right now, for instance, I will say one thing. I disagree strongly with President Trump on tariffs, but I will give him credit for one thing. They're at least saying what a trade-off is. He's saying he's going to use it to fill in the loss in income tax revenue. I think that is a terrible trade-off. I think it's terrible on the broader economy, and I think it's terrible on the distribution. But we do have trade-offs, and I don't think they can be ignored.
Mm-hmm. Okay. That's fair. The interesting thing to me, and yes, 199 Cap A is a good example of a provision that came under particular criticism. And I believed going into 2021 and Build Back Better that it would be one of the first things that Democrats would look to pull back, and yet they didn't. And I think that represents, I'm not going to ask you why, right? I just think it represents, number one, once something happens, it's so hard to undo it. And secondly, the political consensus around, certain constituencies is strong. And it may be with us one way or the other. Yeah.
I'm going to defend 199A, and not going to defend the details of it, because there's lots of people could do it other ways. There's certainly things to complain about with it, but Congress for years has been trying to deal with the fact that the U.S. uniquely, the U.S. has more than 50% of our business income earned outside of corporate solution, and you can't change the corporate. You couldn't bring the corporate rate into line with global corporate rates unless you could deal with all of the businesses that weren't in corporate solution. And Congresses and both parties have for years tried to solve that problem. And it's a very difficult problem to solve. And I have to believe that went into some of why they didn't undo it in BBA.
And absolutely. And, you know, when we talk about it as a small business deduction, and that's what members refer to it as, it's because when they go home to their districts, the small businesses like the provision, right? It's one where they're very vocal in their support of the provision. There are very few code sections that members can just know what they mean. 199 Cap A is one of those, and that just really speaks to how it has directly affected constituents in particular. And they hear about that, right? That's not a talking point. They hear about it at town halls. They hear about it when they go to their states. So, you know, we can talk about the mechanics, but it has been
Many of them had businesses that would have been under it before they went to Congress.
Absolutely. And, you know, popular on both sides, because it's not just Republican members that are hearing about 199 Cap A. It is also, you know, Democratic members as well.
I'm reminded of the Pew does polling of Republicans and Democrats every year. It's probably due for their 2025 version coming out soon. And when they ask Republicans and Democrats alike, are large corporations good for the country? Only 32% of Republican voters and I think 28% of Democratic voters say yes. That's shocking to me. But 88% of Democratic voters say small business is good, and 87% of Republican voters say that. So I think that tells you a lot.
So this is not about small business. If this was just about small business, this provision would not cost what it does, which is quite significant as a provision. And I believe it ended up costing a little more than JCT initially thought it would. As it is about the way we tax major companies that operate in pass-through form and with owners that tend to be high income. There's a reason why when, you know, if you ask JCT or Tax Policy Center, whoever it is, who are the beneficiaries of the 199 Cap A deduction when you look through it, 50% will be with those with AGI over $1 million a year. And I think there is a totally valid, and I agree that there are reasons that we should be looking at how we reform our entity taxation system. Should we have it as elective as we do? Should we push large pass-throughs to be C Corp so we no longer have the kind of elective system we do? But I think that the wrong solution to that problem is to say, well, because we can't figure that out, we're going to fundamentally, basically undermine our individual income tax system and our ability to tax many high-income individuals in terms of the way they receive that money. In terms of investment, there are ways we can handle it, and there were provisions. There's expensing, for instance, that can be targeted at capital investments. So what we're talking about is the marginal tax rate that applies, and especially if you have expensing, to the money on top of that. And this again goes to the issue of trade-offs. If we can't figure out how we're going to tax some of the largest and highest incomes that often comes in pass-through form in an effective way, there will be other trade-offs. Republicans are proposing some, whether it be Medicaid right now in the reconciliation bill, whether it be President Trump in unilateral use of tariffs. And to my eye, that does not look like a good trade-off.
Well, that's a good segue into so that was the should they. We're kind of going into the next point, which is good. How should they? And should they just simply extend them? I'm going to put you down for 199 Cap A needs some, an overhaul or maybe rethinking. But Jen, let me ask you about the other 2017 provisions. Did Congress get it exactly right back in 2017, or is it worth revisiting these extenders and say, as we're extending them, let's think about the policy again?
Well, you know, the code is ever changing and ever evolving, right? So, I mean, I would like to say that, you know, since this was a bill that we worked on, that it was perfect and that we made no mistakes and that it worked exactly as envisioned, but that's not realistic. They never do, right? Show me a tax bill, I'll show you a laundry list of problems in addition to technical amendments that need to be made. So I wouldn't say that it's perfect as is. There's certainly room to make changes. You know, there are areas in the GILTI where a lot of taxpayer feedback has been received with respect to, you know, quirks in the language. There's certainly areas in the BEAT where, you know, had the revenue constraints been different, there would have been different architectural changes made. So I certainly think that there's room for change. I just think that a lot of these questions are revenue driven, you know, when you're drafting a bill. So certainly not perfect, certainly room for modification. Again, making my plug, SALT, I see you. But, you know, that's another area like SALT, but, you know, David, you were mentioning, you know, where money is spent. And that was a significant revenue raiser, right? And, you know, not everyone thinks about that in the same way. You know, that is a revenue raiser that disproportionately hits, you know, the higher income individuals, is very progressive raiser. So, you know, it's all about, you know, the trade-offs, like you said, and there were a lot of trade-offs in that bill. So maybe some of those trade-offs would not have been necessary had there been different revenue constraints.
Well, Barbara, let me ask you, what circumstances have changed since 2017 that, you know, events outside either the U.S. or sort of outside the tax bill itself force us to rethink some of these provisions?
You know, I completely agree the bill's not perfect. There are lots of technical issues that could be addressed. There are also policy issues that could be revisited, but I continue to believe in an environment where something needs to be done by the end of 25. It's really difficult to deal with, because of the balance and the trade-offs, to deal with that. A lot of the issues, a lot of the technical issues that Jen just identified are on the corporate side, when it's the individual side of the bill that needs to be that needs to be dealt with on an urgent basis. And, you know, I think the philosophy of the TCJA, I spent a lot of time with Chairman Brady, so I cannot get out of my head his focus, his singular focus on having a bill that drove growth. So provisions that would encourage economic growth, and focusing on lowering the rates and broadening the base in order to allow businesses and individuals to keep more of their money and choose how to use it, instead of using the tax code to drive some decision making, to encourage particular types of activity. And some of those benefits are the things that people would like to have back, but to pay for them, you'd have to address the rates. So I think revisiting it is difficult. I think there are reasons why you said it had been since '86 since we've done a bill as big as the 2017 bill. It is really hard to making big changes are really hard, and it's really disruptive. But sometimes making smaller changes are even more difficult, in the sense that, well, if he's going to get something he wants, I need something I want, but they both cost, and neither of us are offering up anything to pay for them. In terms of the things that have changed now that we have to deal with, I think a lot of what has changed, well, I do think we have to continue to focus on the fundamental that we can't, with a reduced corporate tax rate, which I believe we have to have in the global economy, we need a rate that is similar to where the rate is now. That is the right place for our corporate tax rate to be. But we can't let the rates for pass-through businesses. And I agree, it's not just about small businesses, but it is about small businesses, because they would be at those higher rates. We can't let those rates go up and keep the corporate rate. I think the biggest thing that I think external force that I think makes it really difficult this year is the ongoing discussions about Pillar 2, and how that factors into what we might do with our corporate international provisions, because it's a little bit of a simultaneous equation. Do we need to respond to Pillar 2? Can the U.S. negotiate enough revisions to Pillar 2 that we don't need to respond, or do they negotiate revisions that then there still is reason why we should be making adjustments to the U.S. rules, so that I won't say align, but they don't butt heads with Pillar 2 in the ways that they do now that cause double taxation?
Yeah, I think we're going to probably talk about that more as the day goes on. syncing the U.S. system with what is happening outside the world is a really, really interesting question. Let me ask this question. Do we think it's inevitable? Congress has relied so heavily on temporary law as a way to, it's the path of least resistance, right? It's, it's cost less, just do it temporarily. Is that what we're headed to? Is there a case for permanence here? Is that a realistic outcome? Anybody?
So I first want to respond to the prior
Yeah,
question
please.
about what's different.
Yeah.
Because I do think it is important as part of discussions to ask why we have a tax system to begin with. What is it trying to finance? And what has changed from 2017 to now? And in terms of what has changed from 2017 to now, I think some of the most important things that have changed mean that this is a less responsible bill than it was at the time it was enacted. And obviously I had my views on it at the time. But to give a little bit of credit, and in a way that I didn't at the time, I do think that relative to where, what I thought in 2017, there was still reason for additional fiscal stimulus for the economy. I think it would have been better to pursue it differently. Infrastructure, for instance, at the time. But the economy was still underperforming in the wake of the Great Recession and the financial crisis. Right now, we have interest rates on the 10-year note, which are over 100 basis points higher than they were in 2017. Obviously, in the last several days, we have seen movements in the treasuries markets, of course, related to tariffs probably, but so that's seeming to suggest the bond market is less stable than we might have hoped. Obviously, we have seen an example in the United Kingdom of a government brought down through a set of irresponsible tax proposals. And I do think while we can get to the predictive moment, and no, I am not particularly optimistic for this very moment, I do think we need to keep our eye on the ball of why we have this system to begin with and what is the size of our government and our size of our commitments. And in that environment, that means, for instance, I think it would be deeply irresponsible for the Republicans to seriously revisit the SALT cap. That was $100 billion a year of revenue raising. Do I like it particularly? I would have done it differently. I would have probably capped it at part of the value. That's what we proposed in the Obama administration. I also wouldn't have allowed the pass-through loophole, but whatever. That's probably something we could agree that if you're going to keep it, you should probably get rid of. Sorry. But that should not be on the table for them. Not when you've got a 10-year note where it's like 100 basis points higher than it was in 2017. You should be really going hard on your revenue raisers. You should be going beyond where they're willing to go. So I just want to emphasize, I'm not particularly optimistic on the prediction right now, but we do as a country and as a set of political matters need to find a way to actually correct some of the dynamics, or else we're going to be rolling the dice on a set of macro indicators, including bond rates and so on, that might not go our way.
Yeah, what's interesting about tax bills is that, large tax bills they're not passed on a week by week basis, right? So they have to have a longer term view. So, they cannot be reactive to market forces last week or, tariffs that are implemented, on a day-to-day basis. So they really, and I do think that TCJA struck this balance with it, in particular in the international system, providing kind of a longer-term framework that has a lot of levers that can be modified in subsequent bills, that there's an opportunity to work within that framework. But I also think that there's always that area, there's in that Venn diagram of, perfect tax policy, if you, in your mind's eye, what you imagine to be the perfect revenue raiser and how you should be raising revenue. And frankly, what's politically possible? What is the possible? A lot of what we may all agree, maybe not, to be great tax policy, fantastic revenue raisers, are just never going to be politically popular. So it's the perfect tax policy is the policy that can actually pass, that has an incremental good, that is moving in a good direction. And I think that oftentimes we kind of negotiate against ourselves when we're thinking about perfect system versus imperfect systems, where we're thinking, perfection cannot be the enemy of the good. when you're thinking about, tax policy and tax bills in particular. I mean, great for papers, but very difficult to implement in a bill text, right? When members are throwing, rotten tomatoes at you,
Yeah.
not popular, not
Yeah.
popular.
I mean, on your question of temporary
Yeah.
versus permanent, I mean, the individual provisions, which are the temporary provisions, were 10-year provisions in TCJ. If it had not been done under reconciliation, those would have been permanent provisions. This is all a feature of the reconciliation rules in the Senate. But in a world where we hadn't used the reconciliation procedure, which has been used a lot for tax, and creates a lot of pain, the exact same bill would have had those provisions permanent.
Yeah, except that I agree with you. Sort of wishing the problem away,
Yeah.
though, because that would have required 60 votes. And if you would have gotten 60 votes, the bill doesn't look the same. Right? It's just so I agree with your point. Well, let me ask one last question before then we move on to this, how budget reconciliation is going to shape this bill. We've talked a lot about the expiring items. We haven't talked about the president's other proposals. Anybody want to say no tax on overtime or no tax on tips or Social Security is a great idea? Or how do we feel about his 15% rate on U.S. manufacturing? Anybody want to weigh in on any of those?
I did want to mention the no tax on tips, and you've heard me say this, John. When it was first proposed, I thought from a as a tax policy person, where does that fit in the tax policy space, like an exemption for tips? And of course, again, this is that area where it was originally a Republican proposal, right? Trump campaigned on it, picked up by both campaigns as extraordinarily popular. So oftentimes, tax policy takes these turns, but that is one of the biggest and most popular proposals that are out there from the administration, and bipartisan support. So,
having gone through TCJ, working for Chairman Brady, the having different treatment of different types of income is something that seems sort of it's using the tax code to try to achieve policy objectives, and I'm not sure that the tax code is the best tool for that. And it creates all those issues about, well, what, suddenly are you going to work for tips, John, instead of a draw from
5
KPMG?
stars. 5 stars, everyone.
We've thought long and hard about it. We haven't figured out how to have our engagement letters have a tip line yet.
I'll certainly be passing the hat in my class. But, and just to jump off that, I do think to now offer praise for an element of the 2017 law is that philosophy, with putting 199 Cafe to the side, but we can go back and forth on that. But you can see the philosophy underlying, even if it didn't raise enough revenue, that there were base broadening measures that were attempting to treat same activities the same. Including in some brave ways that I think that folks that I had worked for probably could never have gotten around to doing. And I appreciate it. I think that these elements really show a move in a very, very different direction, both different than that and also different than the philosophy of 1986. And I know I come back to tariffs, but there's a reason I am doing it. It is not just because they exist, but because there is a very explicit framing being put forward by the Trump administration around tariffs as a replacement for the income tax. And I think it is reflected in proposals like these, which I agree, some of them got, sometimes bad proposals get bipartisan pickup. The TIPS proposal was one, but reflects a philosophy of undermining the tax base in both explicitly in law and then through enforcement, through the potential dramatic cut of the IRS operations, and a replacement with tariffs. And obviously that's a model of the 19th century. President Trump talks about it explicitly. But especially in an environment where President Trump is talking about it so explicitly and is taking the actions he is with regard to the IRS and trying to get these kinds of measures included, I don't think we can ignore the kind of trade-off that he is now putting in front of Congress.
Well, let's because we're sort of now going into how pay for this and how this is all going to construct. I just want to bring this to the accounting for this bill. And again, I know that sounds boring, but because we don't know yet what they're going to do, because they don't yet know what they're going to do, but there are certain things that we know that will shape this bill that are unavoidable. And so, Jen, you're our Senate person. Can you just remind us all how, people in Washington love to say, people are policy, right? Like the policy is driven by the people. Well, that's true to a certain extent. But the one that people don't talk about enough is that process is policy, and that things like budget reconciliation, the process of reconciliation are going to shape this bill. So just remind us why and how that looks.
Well, this is really sad. I get really excited to talk about reconciliation because you don't get to talk about it on an annual basis. It's just when there is a trifecta on the Hill, and usually it's a big tax bill that is being pushed
Every
for
4
reconciliation.
years. Yeah.
Every few years. So reconciliation is a workaround to the filibuster where the Senate can pass a bill, and that's why it's a Senate measure. I mean, it's really a Senate procedure where you can pass a bill with a simple majority, but it's a budgetary rule. So it's it's driven by dollars and cents, as we were talking. It's really driven by the 10-year budgetary window. So they have to be very transparent with respect to, the amount of budget that's going to be utilized in the bill. So that's that resolution that we're talking about. That's step 1 of reconciliation. That's where they say, these are the committees that are going to have the opportunity to include text in the bill. This is how much each of those committees can spend. And then step 2, once the House and Senate are aligned, which they currently aren't, step 2 is actually putting together a bill that complies with those instructions. And because of that, when we talk about the policy, there are a number of, rules with respect to, budget reconciliation. One is that you cannot increase the deficit outside of the 10-year window. And that's not a political statement. That's in the Budget Act, right? That is required. So let's say you may be asking, well, there's a $4.5 trillion deficit allowed in this bill. What are you talking about? All cabin to the 10-year window. Cannot spend a penny that is not offset outside of the 10-year window. And that's why when we talk about, temporary tax policy, at least, when we used to talk about reconciliation driving temporary tax policy, it all depends on the baseline. That has been like the topic of discussion recently. It depends on the baseline that you're using, whether or not you're still increasing, deficits outside of the 10-year window. But typically, if you use a current law baseline, any new spend within your 10-year window is going to cost money outside of the window if it's permanent. And that's why you see all of these reconciliation bills, the policies really impacted. I mean, you saw that in the TCJA. We're talking about the FDII, GILTI, beat rates. Those all started to, tick up because of reconciliation. Everything has to be unwound before the 10 years are up. So it isn't a coincidence that there's a tax cliff this year. It's year 8. And that's usually when you have to start to unwind. So, it's fascinating, and the trade-offs that have to be made, permanence versus temporary. Anything permanent has to be offset outside of the 10-year window. So that turns into new policy.
So that then leads us, I think, to the inevitability that they have to pay for this, maybe air quote pay for, depending on how you think of it, this in some way. There are tax increases as a possibility. There are spending cuts as a possibility. There are alternative revenue sources like tariffs or other things we could talk about as a possibility. Let me just ask this one that is especially unique and novel, and maybe Barbara, I'll just get you to first weigh in on this idea of current policy baseline, that if it's current law and simply extending current law, this is the Senate's position, is that why should we pay for that, right? We're just preventing a tax increase. Why do we have to raise taxes or cut spending to prevent a tax increase? I guess would be a way to summarize the way they think about it. What are your thoughts on the idea of current policy baseline?
Yeah, certainly when you talk about it, some people look at it sort of with horror that it's some kind of gimmick, but you really need to remember that is how it works when you're not doing something in reconciliation. So I worked on the 97 bill when I was on the Joint Committee staff, the 2004 bill, like bills that were done outside of reconciliation. It's very freeing to not have the reconciliation rules. But in that situation, you have a 10-year score for the bill. That's the score for the bill, but everything continues beyond the 10 years. And so when you think about it that way, the baseline question is really just trying to undermine the procedural rule of reconciliation as to how to avoid needing 60 votes in the Senate. It's not really a budgetary change. And all of these estimates are estimates. And the tools that the Joint Committee has are limited, not a criticism at all on the Joint Committee, but the tools are limited, and there's a lot of uncertainty. You know, they have to sort of assume a can opener in economics and all the other things that change in the world. And so the other economic analysis that gets done that doesn't factor into the budgeting, like broader macroeconomic analysis, is information that should be important to policymakers. Is this provision more likely to drive growth? We won't estimate the amount of growth and count it, but if it's going to drive growth, that would be good.
So a couple things. First, whatever baseline you use doesn't change the bottom line deficit, and the fact the government has a deficit going forward that is too large. And it also doesn't change the rate of the 10-year note. Second, the problem with current policy, and having been one of the few people, and no one has read it, that actually has written something saying, like, maybe they should use a current policy baseline. The problem with the use of it here, when it comes to the budget enforcement rules that Congress has made, is not the idea of using a current policy baseline. The problem is the inconsistency. So if you want, if you want budget enforcement to mean anything, and not just to be sort of a joke, but you could also choose that it's a joke, you should be consistent in your approach. So a consistent use of a current policy baseline would have meant that at the time the 2017 law was enacted, you would not have assumed in any scoring that an expiration would come into place, because you would say it just continues. And then they would have needed to either pay for it outside the 10-year window, which they couldn't do, or drop the bill. So they didn't use it. It is then inconsistent to say when you're coming back to extend it, oh, now is the time we will use the current policy baseline. Obviously, Democrats could get the same idea. We'll do everything we love for a year, and then say, but guess what? Now it doesn't cost anything to extend. In the end, maybe we could just say the budget enforcement rules shouldn't matter, but in a world in which we have deficits like we do, they probably should be mattering more rather than less. So I'm just like, does it make sense? No. Does it undermine their budget enforcement rules? Yes.
I mean, one of the interesting things about the current policy baseline, I don't know if you all agree with this, but we were thinking about, so there's something that also expires at the end of this year that is not TCJA related, and that's the premium tax credit from ARPA, right? It dates back to Obamacare, but it was increased during ARPA.
Yeah.
If we allow that to expire, am I thinking about this right? It costs $220 billion to extend for 10 years. Allowing it to expire is a revenue raiser of $220 billion in a current policy baseline world? I mean, this is what's up is down and what's down is up here, right? It's a really interesting dynamic. Yeah. Let me ask a couple other things then about offsets. The House is talking about trillions of dollars of spending cuts. Is that realistic? We've been talking about spending cuts my entire time in Washington. We have never seen anything of that magnitude. Is that, if that's what is going to have to happen to require a tax bill to pass, do we think that makes it less likely that the bill passes? I don't want to put anybody on the spot. You're looking at me like, don't make me answer that.
Spending cuts are not popular with either party.
I know.
Yeah, it's really difficult. And we're all guilty of it too. I was just joking with our team during our policy call that spending cuts are like when you can all agree that your credit card bill is too high, but when you open your statement, you can justify every single expenditure, right? You don't want to give up any of the things that you just spent money on. Congress, that is their exercise, right? They're going through their statement, and it's really hard to make those trade-offs, and it's extremely unpopular because there is a reason for every single one of those items.
Yeah.
So, and I'll defer on what exactly the Republican Party will come around in terms of their support. But again, the spending cuts that have been put on the table are ones that are a bad trade. It's Medicaid, is to the degree that it's significant reductions. That would probably maybe the single largest source. That was the single largest source in the House version of the resolution. Second to that would be SNAP, nutrition assistance benefits. And so you can probably guess as the kinds of families that would bear the burden of that. And so I hope not. I do think there are spending reductions that would be sensible potentially, but those are not them. But I think it also reflects the fact that as right now conceived, this bill is based on a bad set of trades.
Fair enough. Okay, we're going to ask for questions. So get your question ready. I'm going to ask one last question. I'll direct it to you, to David, and anybody else that wants to answer it. What about non-conventional sources of revenue like tariffs or DOGE? Are these meaningful numbers that should be included in the accounting for this bill?
The tariffs are meaningful. I think we now get our, people were questioning whether or not, and I was hoping they wouldn't be meaningful in the sense that I don't think they are a good idea. But they are meaningful in whatever iteration they are in. It is a remarkable world where there is celebration and it's like, he's pulled it back, and there's a 10% across the board tariff that remains, and you can do the simple math. In a world of $3 trillion a year of imports, a 10% across the board tariff, just multiplying it out, $300 billion a year, you'd have to take into some dynamic, effects, but that is a not small amount of money that would be collected on a unilateral basis by the executive. I do think there are questions whether that is in fact legal under IEEPA and the Constitution. But that's a real source of revenue. As I said, I appreciate, if that's the trade, I appreciate they are putting it forward as at least a clear trade-off that wouldn't probably fully pay for the bill, but pays for part of it, and I think it should be rejected. In terms of DOGE, no. It seems likely to me on current course and speed that DOGE loses the government revenue on net and money on net because of its effects on the IRS. And the cuts to the rest of the government, which will especially affect non-defense discretionary, which is 15% of the budget or somewhere in that range, are probably not sensible, are small relative to the kinds of effects on the deficit that are likely to happen through the severe cutback of the IRS.
Okay. Anybody else on that? Surely somebody out there has a question. Don't be shy. Somebody has to ask the first one of the day. Because I'll keep asking questions. All right, well, we have four. Oh, yeah, please. I'll repeat it. Okay, there we go. There's a mic.
Thanks. So you're talking about things that have happened since the 2017 Tax Act. And David, you mentioned a little bit of this, but the guidance, some guidance after the 2017 Tax Act seemed to be highly inconsistent with what the drafters intended. So for example, 199 Cap A, we heard a lot about guardrails and the skill and reputation limitation, which the Treasury read that completely out of. And then of course, we also have, there's a mention about SALT cap being progressive. Well, the entity workarounds are just awful on that. So you have law firm partners that are effectively deducting in full their taxes, but the associates and paralegals get hit by it. So I wonder, is there going to be any thought about, if you think 2017, the drafters were correct on these ideas, I think the guidance ran completely away with that in a way that really continues to, adds to debasing the income tax base. And so I'm interested in thoughts on that. Thanks.
I'm sure there are others that could put their hands up and cite some regulations that they think were tighter than the TCJ was, lots of them. And so I think it goes both ways. I think that would be a very interesting discussion to have. I think there's a panel later on Loper Bright. Big litigation questions, but what does that mean for how tax legislation should be drafted or will be drafted in the future? I think I'd ask that question again later.
But just to say, you should ask it later, and Congress should fix it now. Because I imagine, if just guessing what happens when we talk about later, they will then explain all of the dangers that occur with Treasury guidance, and especially a Treasury flippant position under Skidmore deference and so on, or whatever you want to call it. And so if Congress wants to shut down, and they should, of course, shut down the pass-through effectively deduction of SALT, they should do it now. They have legislation on the table.
Good question. Thank you. We probably have time for one more. Shirley, one more. Please.
There was some mention of the next board tax credit, which is really part of what's involved in the European value-added taxes. Is there any reason that instead of maybe tariffs to raise money, that we look at an international VAT so that we give an export credit for exports and we impose a value-added tax on imports.
Anybody want to take the VAT
Border
question?
adjustability.
Oh boy.
So, on the one hand, this is the great dream, I feel like, of certain economists, that this all becomes the destination-based cash flow tax,
Right.
and we're back to the bat, and well, wow, look where we've come. I do think, though, and this is like, if only, if that's where this ended up, everyone would be like, wow, that was quite the journey. Tariffs aren't the same thing, and maybe someone could convince them they are, which would be nice, but they aren't. A VAT is not actually a trade restriction. It is a neutral treatment of taxation of consumption within the economy, despite what some might get confused about when it comes to the border adjustment of a VAT. The same would be true of the DBCFT. So could it? That sounds like a good trade. That sounds like a good trade. The problem will be, does the current Republican Party, the Trump administration, actually believe sincerely in barriers to trade? And then that becomes harder because that is a real substantive difference.
Well, with that, we are out of time. Panelists, that was amazing. Audience, we're going to continue this for another hour out in the hallway. So join us out there now. Okay, thank you.
Okay, thank you. While our next panel comes up, I'll start some of the introductions. Our second panel discussion today, Controversial Controversy, will explore recent IRS guidance and enforcement trends concerning transfer pricing disputes. This panel will be moderated by Cameron Tahiri, the global leader of KPMG's transfer pricing dispute resolution practice. Cameron is a member of KPMG's Washington National Tax Practice and specializes in resolving transfer pricing disputes on behalf of multinational corporations, including advanced pricing agreements, competent authority settlements, and examination and appeals. He has negotiated and closed over 150 APA and MAP cases with countries spanning the globe. Prior to joining KPMG, Cameron was a team leader in the Advanced Pricing and Mutual Agreement Program at the Internal Revenue Service. Joining Cameron on this panel, to his left, is Jenny Austin, a partner with Mayer Brown, specializing in federal tax controversy and litigation. Jenny regularly advises clients facing a variety of domestic and international issues, and her tax controversy experience spans a diverse array of subject matter areas, including transfer pricing, cross-border, corporate restructurings, and debt equity, treaty regulation, and judicial doctrine issues. Her experience includes resolving complex matters for multinational enterprises before IRS exam and IRS appeals, and has litigated cases including resolution of transfer pricing issues for multinationals. To Jenny's left is David Farhat, who is a partner at Skadden. David focuses on all phases of international tax planning and dispute resolution, having advised some of the largest global companies on their most complex multi-jurisdictional issues. He has extensive experience in resolving contentious and complex transfer pricing disputes. David formerly worked at the IRS, where he handled a variety of issues involving advanced pricing and mutual agreement programs, and developed and negotiated bilateral and multilateral advanced pricing agreements and mutual agreement procedures with a number of U.S. treaty partners. To David's left is Peter Blessing, the Associate Chief Counsel International in the IRS Office of Chief Counsel, where he oversees an office of 100 international tax attorneys and other professionals responsible for legal advice, guidance, and support to the IRS, Treasury, and other agencies, and the public on international tax issues in all procedural postures. Prior to joining counsel in 2019, Peter practiced for over 30 years with Sherman & Sterling and an additional 6 years in KPMG's Washington National Tax Office. Panel, turn it over to you.
Thanks, Stephen, and thank you everybody for joining. We have a packed agenda today. Want to tie in to a little bit of the themes I think that came up on the last panel, right? So obviously in scoring, TCJA as well as Inflation Reduction Act, a lot has been made of IRS enforcement, and that may decrease depending on what the Trump administration does with the current IRS budget. And so we'll sprinkle in some discussions on enforcement and kind of where we think that may be going. It's hard to predict at this time, right? It's a changing environment. So we'll sprinkle that in, but really our theme for today is what is causing controversy out there, right? And in that we have IRS guidance that's been put out in the past couple of years, in which some taxpayers agree with, some taxpayers disagree with, but certainly having to grapple with that. And so we'll go through some of that guidance. Also, at the same time, we see taxpayers wanting to achieve certainty, and that certainty really being achieved through the mutual agreement or advanced pricing and mutual agreement program, and focus on where we see some trends coming up with that program as taxpayers want to get certainty on treaty-based and transfer pricing disputes. And then finally, to the extent that they aren't able to get certainty either through these processes or at IRS appeals, litigation. What are the trends that we're seeing when it comes to litigation with the IRS, and how is that affecting clients and taxpayers' behavior? So that's a little bit of our theme today. We'll probably just jump right into the IRS guidance. We put a little bit of the of some of that guidance up here, and I think shared in the materials as well. And so want to start with I think it's the most recent guidance that was put out there around periodic adjustments. So to the extent that taxpayers have profit splits or are in cost sharing arrangements, when is it appropriate, for example, for the IRS to look to make adjustments to those arrangements almost on an after the fact basis? There's language in the regs that support some of this, and then there was additional guidance released by the IRS on the one that was appropriate. Maybe Peter, I will throw it over to you to talk about that GLAM.
Okay. Yeah. So the panel thought these would be of some interest, but some of them have been talked about before. I'm tasked with summarizing them, and then they'll throw cold water on them. But I'll start with the periodic adjustments in Section 482 interaction of that provision in the regs. And essentially, the scope is high value, high profit, high value, hard to value intangibles. So basically intangibles where there's not a comparable. And we'd addressed this before back in 2007, and those of us at the service now thought we should revisit that, because we believe that the statute means what the statute says, and the regulations mean what the regulations say, and the GLAM essentially reflects that. So it goes through the history, starting with the 86 Act and the white paper and the series of regulations, and analyzes the regulations. We basically have the conclusion that in such a transfer, the taxpayer, first of all, cannot itself invoke the periodic adjustment regulations, that commensurate with income sentence, which is the second sentence of Section 482, on which the regs are based, refers back to, is basically references the first sentence, which is clearly only in the discretion of the IRS. So that's point one. The second point is that if the IRS looks at first of all, if the taxpayer is outside of the threshold, let's say there's essentially a band between 80% and 120% of the pricing of the transaction within which periodic adjustment never would apply. And one can quibble about whether that band is really generous enough or whatever, but it's in the regulations and has been there. So if you're outside of that band, then the taxpayer has certain exceptions available to it in the periodic adjustment rules, and they're not easy to meet necessarily, but those are the way out for the taxpayer if the IRS determines in its discretion to take into account to take consideration of actual profits, what we call ex post profits or ex post facts. And if the taxpayer cannot meet those exceptions, and they're in -4F and and for qualified cost sharing arrangements -7I6, then the taxpayer cannot overcome the periodic adjustments using general arm's length standard language and 482-1B, or using a specific method such as cut. And that's essentially the gist of it. There's an example in the regs that illustrates the taxpayer transferring. As you can imagine, I said at the beginning, these are hard to value, high profit, quasi-unique, if not unique, intangibles. The taxpayer in the example cannot show that the purported comparable is the same property, transferred under substantially similar circumstances, and with the same use limitation. And under those circumstances, the taxpayer has not met the way out of a IRS consideration of ex post profits. I'll now turn it over to the
and
panel
maybe
to say what a great glam that is, and why didn't we say that before?
Well, maybe along those lines, this might be the nicest thing I have to say today, Peter. I actually appreciate all the glams we're going to talk about, because by the time the glam is issued on any of these issues, we've already seen these issues starting to pop up in audits or in litigation. And so for us to have the government's position truly laid out, as thoroughly and thoughtfully, has been very helpful. And so I really do appreciate the team effort that you and your team are putting together these glams, because they are very helpful for us and for taxpayers. My concern with the periodic adjustment glam is, I think when it first came out, most people, right, didn't seem very noteworthy, it didn't seem very new, and yet when you delved into it, the concern that comes up is, does this mean that we may be walking away from the arm's length standard, right? And arm's length standard is not codified in this statute, and so are we setting ourselves up for a world of a lot of pain if we are abandoning the arm's length standard?
Can I say something to that? First of all, Jenny makes a good point, and I should have mentioned these things arise out of what we see on exam. And so we had seen taxpayers asserting general arm's length standard principles and so forth. And I also thought it was surprising that the press didn't pick it up for a while. Nobody made mention of it, but now they have. I guess I'll leave it at that.
And I think part of that tension is the arm's length standard, and then the commensurate with income standard that's also in the statute in 482. But at the same time, this hasn't been an area where we've seen a lot of enforcement. I think there's been a lot of articles written about potential enforcement. And in my view, maybe there's some tension between the current glam and the 2007 one that was previously released. I don't know, David, if you have any comments on that.
Just to echo the point just made, it's good to see it come out, but then you wonder, well, why now? What's going to happen? The tension with the arm's length standard, and to be a bit more practical with this, you worry about your how controversy impacts you around the world. If this were just a one-sided thing where taxpayers just had to worry about the U.S., it would be one thing. You can fight it out, figure out a solution. But you typically have one or more tax authorities on the other side that will have to live with this, right? And I know we'll get into this a bit more in MAP and APA trends. But as Peter mentioned, this is about hard to value intangibles. So there's going to be differences of opinions. You're typically not going to have comparables. So having something like this come in after the fact can create a lot of havoc. Right? And I think that's one of the biggest concerns, not just, okay, we can be big-brained about this and argue about the technical, but what's the practical impact of having an adjustment like this midstream?
Yeah, and maybe I'll add two things to that, right? One, the BEPS 1.0 initiative memorialize these hard to value intangibles, a little bit of a different computation and standard in that guidance. Although interestingly enough, the GLAM refers to that as an example, but then disavows it for US law purposes. So it's kind of like an interesting contrast in there. But I think the second thing I want to point out is, this is an area for that just compliance and tracking for taxpayers. You enter into a transaction, contribute some IP back in 2015, it's 2025. You'll still need to track, arguably perhaps taxpayers should have been tracking kind of what that profit potential and if you had stayed within certain ratios or not, but it does become unwieldy, right, David?
Most definitely, and I think that becomes a concern. And I'm happy you mentioned BEPS 1.0. I think the tax community is just now seeing the impact of that, what the audits look like, what positions folks are taking, and again, focusing on the practical. It's one thing to have a conversation with Peter. It's another thing to have a conversation with the boots on the ground, so to speak, right? How will this GLAM then be interpreted by the folks doing an exam? How will it be interpreted in appeals, right? And then how is it going to be looked at by tax authorities, outside of the U.S.? So it's just what gives me heartburn, as you say, the tracking the whole time, the complexity, and how do you account for that over time, right?
Although it's likely that 10 years later, we've already had audits and disputes about the original pricing.
Exactly.
Right. And if these really are, unique intangibles, we already are disagreeing about what the arm's length price is to begin with.
Yeah, although I think the GLAM suggests that you can have a dispute over the PCT payment, that occurred, maybe have that, 2015 transaction, have that dispute in 20, resolve it, still get an adjustment in 25, despite having, an adjustment on the PCT payment.
Yeah, that's an important point. And the example says year 1, the license took place. Year 6 and 7 are under examination. No changes made in year 6. Change nevertheless can be made in year 7, and we feel very strongly about that. That obviously that has come up in cases too. On the arm's length standard, we were careful to. We had 2 choices. Say Congress did what it did. Doesn't sound too arm's length. It's not. Or we could say, as was done in the past, arm's length standard is we use the word capacious because we went to English, studied English. Capacious concept.
Because you went to NYU,
encompass,
right?
encompass this action by Congress. And we do mention, as David noted, or Cameron noted, that the footnote does refer to the OECD guidelines, and they are not identical, but very similar. So we don't think the map issue is as big as somebody might otherwise think.
And so maybe we'll move on to the next topic, which comes up, typically around financial transactions and the concept of whether implicit support is needed to take into account when you're pricing a intercompany loan or intercompany guarantee. Peter, do you want to kind of walk us through that guidance?
Yeah. So the prior one relied on the second sentence of 482. The implicit support GLAM essentially relies on the third sentence of 482, the reference to realistic alternatives. And essentially, it just illustrates a very simple fact pattern. Foreign parent lends to U.S. sub. Foreign parent has an A rating. U.S. sub has on a standalone basis, would have a B rating. That would be an 8% rate in the view of the credit agencies, or doing a credit agency analysis, a rating agency analysis. And the loan on a standalone basis is made at a 10% rate. The standalone rate is 10%. The loan was made on 10%. The actual rate for the rating agencies is that with implicit support, the USS would have a rating of BBB, not B, and that would be 8%. So you have that delta between 8% and 10%, assuming no guarantees, et cetera. So the simple way to look at it is that the realistic alternative of USS with that credit rating is to go borrow from a third party, and it can do that at 8%. So why is it paying 10% to the parent? Sounds simple. From parent standpoint, people say, well, parents got to be compensated for the credit support it's providing, so it should get 10%. We don't think so. We think that also the realistic alternative is 8%. And that is because the comparable is the parent lending to the USS of an unrelated party, which also has implicit support, and likely, if it's true comparable, the same implicit support, so exactly the same. So we think that if 10% is paid, the extra 2% is paid to the parent in its capacity as an equity holder, so quasi-equity return, and that's also underscored by the fact that the U.S. parent would not have been compensated at all had a third party made a loan to USS. So I'll turn it over to the panel now.
Do you want to go?
Again,
be nice now.
I'll be nice on this one. I think some folks believe this conflicts with a kind of reading of the regs as they are, and I'll leave that there. And then again, focus on the practical implications. I think one of the things for this that gives me a lot of heartburn is the pricing of that implicit support, right? How do I get the right price of it? And I think the example you gave is a pretty straightforward one, but unfortunately, in most cases, you won't have it that straightforward. And I think we've had problems in the past kind of using a third party, recommendation of an interest rate as a comparable, saying, well, no, you have a relationship with that bank, and we're not sure if this is a proper comparable. So the pricing of that implicit support and what does it represent can be tough. It also brings in real questions about guarantee fees, right? So even if you have a guarantee and it's all your paperwork is correct and you've done all of that, what happens with that under the implicit support concept? And it can be very difficult because you ask yourself, well, will a parent really let the sub default? And then what does that mean? How does it happen? And you get into this, what I like to call kind of transfer pricing philosophy, right? Because you're looking at an animal that doesn't exist in the wild and you're trying to figure out how that works. And again, I think those conversations, you can nerd out on them, you can come to a resolution. But again, it gives me heartburn in the practical because you're looking at least two sides of this thing, and we have the U.S. view and the GLAM. How does the U.S. kind of value or price that implicit support? And then you have the view on the outside and how they look at that. And then how do you get the two sides to meet so you can have certainty, right? I think in this, excuse me, in this tax environment where you have, BEPS 2.0, TCJA, double tax, I think, is more important now than the ETR. And I think this GLAM gives me heartburn that you will have some double tax.
And we saw some OECD guidance around Chapter 10 on financial transactions get issued, but each country interprets that a little bit differently if they're, a lender or a borrower in this situation. I know when it comes to the U.S., we have had a lot of action on this, enforcement action on this issue. Jenny, do you want to comment maybe from a U.S. perspective?
Yeah, well, and just following up on a couple of things David said, I always come back to you. One, why is the implicit support worth more than an explicit guarantee? So that's my first fundamental, problem or question. And then why are we assuming that the parent's credit rating would not change if it went out to an external lender to take on such significant debt? So assuming that is a static, I think, credit rating is also an issue. But this is an area of significant disputes in the U.S. There's a case that's docketed in tax court with many more to come, from just a transfer pricing or just perspective, that many of these cases we're seeing either in audit or in appeals, and the IRS position is consistently the same across the board. So this is going to be an area of forthcoming, litigation and disputes, and eventually, here in the U.S., we're going to have an answer from the courts. Hopefully, it's taxpayer favorable. That would be good for my clients and yours. But this is also it's an area where we have global disputes. So this isn't an isolated issue in the U.S. That we go dating back years, right? Canada, Australia, Singapore, many of the European countries. This is an issue where we're fighting this fight around the globe, and there are no consistent positions, which creates a lot of uncertainty for taxpayers with just what to do in these situations.
No, absolutely. And I think I'll say another nice thing about the IRS there. I understand the frustration with it, and I understand the need for guidance. And kind of with what we've seen over time in this particular space, I can empathize with the IRS's frustration. So something has to be done, and the complexity isn't just there for us, the taxpayer, but it is also there for tax authorities. So I do understand that point. While I may not necessarily agree with the direction of travel of resolving it, I do understand that there is a need to confront it.
And this is an area that had been on the priority guidance plan for
Absolutely.
the IRS to issue new regulations for quite a while. Probably for reasons Peter can explain or not explain if we prefer not to. Hasn't been issued, but again, in the spirit of cooperation, do appreciate that the GLAM had been issued to memorialize that, to kind of put taxpayers on notice. But as Jenny had mentioned, we'll get case law in the near future and see whether or not it conflicts with that GLAM. Maybe moving on to the.
Well, let me just,
please go ahead.
Yeah, as I'll just say, we in Chief Counsel would like to revise certain of the 482 regulations, have for a while, for a few years, but there are reasons it's,
There's
a lot of
going
it,
on.
frankly, was the Pillar project, which absorbed the oxygen in the room on the ITC side.
Got it. And so maybe moving on to the.
Well, one more thing.
Please.
Because David mentioned, you were concerned about the factual differentiation. Nobody's saying that you just simply do the mock rating agency analysis and have exactly the same. Because the rating agencies do take into account certain other factors. They adjust a little bit. But we can't get into those factual issues. We're just trying to lay out the legal analysis. And the second thing I would say is the double taxation, in essence, we should be reducing the chances of double taxation because the OECD guidelines have long taken into account implicit support. So it may be that the taxpayers are fighting, when you say they're fighting all of the tax authorities, and I can understand that, but I don't think it's, double taxation situation as much.
And so maybe we'll move on to another area of guidance that was issued that kind of involves IP transfers and looking at realistic alternatives and specifically how to take into account the tax amortization benefit. Peter, do you want to kind of take us through that guidance?
So this one also relies on realistic alternatives. So the TCJA, I should have said was added in 2017 by TCJA. There was a realistic alternative concept in the regulations, but it's much better to have it in the statute, and that's what we rely on. So this GLAM basically involves a U.S. company manufacturing and selling and distributing make and sell arrangement with a patent, and just assume that the patent or the profits attributable to the patent can be estimated accurately enough and the number used in the GLAM is 135, and the U.S. parent is subject to a 26% tax rate, and that works out to about 100 after tax. So then the U.S. parent decides to shift the make and sell business for country A to CSC operating in country A. And as a result of that shift, the question comes up, what should the CFC pay for a license of the patent, what royalty amount? And the GLAM says, you won't be surprised, it should pay 135 because that leaves the U.S. company with 100 after tax, which is what it would have had on the profit attributable to the patent if it had not done that. If it gets anything less than 135, it's not a realistic alternative. And from the subsidiary standpoint, and that simple fact pattern, the subsidiary is in a country that allows it to deduct the royalties. And so it can pay 135, which is the total income it gets from the patent. In other words, it's not hurt by the transaction. It's got zero profit left over from the patent, but it had zero profit from the patent before the transaction. So that essentially is the GLAM. It does go through a couple of alternatives. It looks at the same thing in a 367D context and also in a qualified cost sharing contribution context. Reaches the same result.
I mean, the example that's in the GLAM highlights just one of the frustrating themes about every realistic alternative that the government presents. It's always one-sided. It's always only looking at it from the US perspective and not taking into account the other side of the transaction. And so in every arrangement, there's two sides to the arrangement, and so you have to take into account both sides. Would that subsidiary, if they were independent, manufacture a product for zero profit? Of course not, right? And so there are maybe other reasons why you have to take into account, different alternatives or look at what the company actually did rather than focusing on this profit belongs in the US, because maybe it could have made it itself, although it probably couldn't, but that's usually not part of the analysis.
And so this is trying to align like the buyer and the seller approach, right? Does it align? Do they end up agreeing on a number in like third-party situations? And how does this get taken into account? David, any
No, I
thoughts?
think that's, yeah, 100% agree on that one. I think given time, we'll go into it a bit more.
Yeah, so this was a very simple example with a single arm's length data point was assumed. And so the GLAM acknowledges that there can be more complicated analysis required for risk, et cetera, if there's other factors going on. But one could also say, and we didn't say it in the GLAM, but one could also say there just is no CFC in country A is never going to be a realistic alternative. You're only going to lose money by doing that operation.
But this
don't
is,
take tax into account.
just as also to add from kind of a foreign perspective, this is a concept that other countries, I'll single out Israel, for example, they issued a kind of a draft circular around purchase of IP, and they very much want you to include a gross up for the tax benefit in Israel as well. So it's a concept that as companies are making more acquisitions and perhaps centralizing that IP in the US, this sort of gross up concept or taking into account the benefit will actually kind of increase the purchase price from the US perspective.
Should add, this isn't new. The other, the post, taking into account taxes, so the post-tax discounting rate and post-tax cash flows, and then you translate that to a pre-tax amount when you're for the actual sale price, because people don't have the sale price that's post-tax. That's not new. It's been in the qualified cost sharing arrangements in the -7 regs. It says explicitly do your comps on a post-tax basis. The other regs are older than that, and so they, it wasn't really thought through at that point. But bottom line, it's saying tax is not something to be ignored. That's part of the operating environment, and it's relevant to arm's length pricing.
So I want to move on to kind of the next topic here around business purpose, economic substance, in an area where there was, kind of the authority removed, if you will. You used to have to get supervisory approval. I think, Peter, any comments around kind of how that interaction works from a internal IRS perspective and kind of coordination with counsel around economic substance and business purpose penalties?
Well, when that statute was enacted in 2010, there was a lot of consternation from the tax community, and as a result, the IRS initiated these procedures. I can't speak for the IRS's decisions one way or the other, so rather not. But I'll just say that the statute's been around a long time. We have to enforce statutes that are there. We can't ignore the statute. It's an antidote for literalism, and we sort of like it.
And I think we've seen the trend, though, around removing this approval has led to increased enforcement. David or Jenny, who?
Yeah, it's I for one would like to see more council involvement in how this is applied.
We are involved. Oh, in the conferences.
Well,
I should have said.
No.
I should have said that
Make
when
less.
it ultimately has to make its way into a NOPA.
Yeah.
We're heavily involved at that point.
Yeah, Peter, I'd love to see you guys are involved earlier in that process. To be honest, because I'm a bit uncomfortable with how it's being used and how it's being put forward. And just to give an example, talking to the IRS on a transaction, the first thing is, well, you could have done this a different way. And you step back and say, okay, are you recharacterizing? Is that no? I said no. We're talking about pricing, but you could have done this a different way. And I think just those kinds of conversations become a bit uncomfortable, for lack of a better term. And I think more council involvement in how this is applied, how it's used would be better. Because I think with a lot of the rules that we deal with, you have your official interpretations, you have your guidance, but how it's applied boots on the ground can sometimes not necessarily align with that. And I think that's important.
Yeah, I think the taxpayer consternation back in 2010 is quickly being proven to be correct.
Prescient.
That
NYU words.
Oh, I know, but I didn't even recognize the school, and I went here 20 plus years ago. Yeah, so clearly I've started talking more simply. No, but right, like since it was lifted, so that makes it much more easier for exam teams to apply the economic substance doctrine. The first question we see for any transaction where they don't like the result is, well, what's your business purpose for every step? What's your business purpose for a check the box election? What's your business purpose for, really every step in the transaction? And what I am seeing is that it is essentially being used as if it's a general anti-avoidance rule. And I've seen this in arguments being made by the IRS that 77010, codified economic substance, now sits on top of the code. And you don't get to the operational provisions unless you pass go. And that's not, I don't think, what it was intended at the time it was codified, but that is how we are now seeing it being applied. And we have many disputes already docketed in tax court and district courts and the Court of Federal Claims where we are now fighting economic substance for transactions that historically we would never have been talking about economic substance. And I think this is an area where taxpayers, whether it be transactions you've done for years that haven't been audited yet, or transactions that you're currently doing, you have to look at this with a view towards how is the IRS in this new economic substance world going to look at this transaction, and what can I do now to make sure that I am better off when the IRS does examine this transaction.
And I'm happy you bring up general anti-avoidance or GAR, because I think that was an area where taxpayers and the IRS were kind of hand in hand for a long time, looking at the rest of the world and coming up with these general anti-avoidance provisions and saying, well, we have the arm's length standard, you have to look at this, there's a long path to recharacterization, which again is my desire to kind of have counsel in the picture earlier, right? To kind of make those arguments, because if you, and as we go into the MAP and APA trends, I think we'll touch on this. If you have your general anti-avoidance arguments outside, you have your kind of business purpose arguments in the US, and they clash as to what the result should be, you have a far more complicated time if you're dealing with kind of competent authority and how to resolve double tax. Because again, it's harder to have a negotiation where you're coming to a result that maybe makes all three parties equally upset, right? If you can't make everyone happy. But now you have these arguments coming in where you don't get to the pricing for a long time, and that can really frustrate the process and competent authority.
Well, and that assumes you have competent authority, because there's also
Precisely.
the argument, right? These are domestic questions,
Yep.
and so competent authority is not available to answer questions or issues or to provide relief for 77010 issues.
No, absolutely. And again, this is where I say the taxpayers in the U.S. were lockstep on this, because the push from the USCA to their treaty partners would no, these should be in the treaty. This is taxation inconsistent with the treaty. But if you now have some of these arguments coming out of the U.S., what does that do for our ability to argue that in competent authority? Yeah, so it's a great point. You may not even get competent authority relief.
And maybe this is a good transition to the MAP and APA trends.
Oh, before you go
yeah,
there.
please, Peter, go ahead.
One thing I want to note is that I think the reg challenges have invigorated the business economic substance doctrines to some extent. So in other words, we would love to taxpayers just follow the regulations. We wouldn't get into this sort of thing. But second thing is there's a business purpose doctrine, and the legislative history to 77010 describes that. And I always found we like the investoring cases, so any investoring case there. So one of them is, besides ACM, which is the one most people think, is ASA investorings, and it describes this doctrine in nice detail. So I think of the 77010, although it's called economic substance doctrine, as having two legs. One is economic substance and one is the business purpose doctrine. And the main point of the statute was to say taxpayers have to be good on both. That's the conjunctive test. And so we might argue business purpose doctrine and its plain old common law right, so as not to cause somebody jitters about an automatic penalty. But we have to enforce the statute again. It's the statute, and let's be honest, the transactions where it arises for the most part are pretty egregious. We're talking about shifting huge amounts of basis on sliver stock. That was clearly orchestrated just to take advantage of a shift of basis. Could have been under the PTEP regs, the old PTEP regs that were withdrawn, or it could have been under 304, 302. We see justifications for that. I don't see it so much I don't think it belongs in transfer pricing per se, but there's cases where that involve both issues, where it's a business purpose, or call it economic substance, whatever, issue, but there's also a transfer pricing aspect to it. But I would not say that is injecting economic substance into every transfer pricing case.
And so maybe it's a good transition. A lot going on with respect to kind of enforcement and guidance and activity. We'll see how that kind of percolates with the IRS funding, whether or not how much it gets reduced, I should say, not whether or not it gets reduced. But an area I think where we've seen a lot of positivity and hope it continues is in the mutual agreement procedure and APA program, where for a variety of reasons, part of it has to do with BEPS 1.0, where taxpayers have maybe gotten out of structures in which a treaty was not applicable, and now they're into structures in which there is double tax on the other side, which we'll also see in a Pillar 2 environment. But also some changes from a IRS perspective with RevProc 2015-40 around kind of making a choice early on whether or not you go to competent authority or you go to appeals. We've seen that program kind of rise in popularity. I know, David, they just issued their annual report on APAs, I think it was last week or 2 weeks ago.
Yeah.
Maybe any thoughts on kind of the state of the program?
Again, I'm impressed with where the program is, given everything that's happened recently. Right, I think folks are still working, folks are still plugging along. Is it perfect? No. But I think folks are still working towards the goal of eliminating double tax, right? And I think it's still one of the better places in not just in the service, but in other countries as well, their competent authority program to deal with transfer pricing issues. I think the cases, based on everything we just discussed, with general entity avoidance and all of these other arguments, I think you're seeing some different arguments come into competent authority, and I think for the most part they've handled them well. We don't necessarily always agree on how they handle them, but I think that the willingness to handle some of them has been there. But transfer pricing isn't just pricing anymore. You're not just talking about the price. You're talking about all these other issues, and I think they've handled that well. I am concerned about what happens going forward, but I think the program's doing well. The folks there are great. I fight with them a lot, but I do appreciate the ability to fight with them.
I think some highlights coming out of that annual report. We see that kind of maybe the usual suspects of Japan and Canada being kind of top of the list around countries in which taxpayers have signed APAs. But we saw India being, I think it was either first or second in the.
Yeah, it was up there.
Yeah, in there, and it, maybe in those who've kind of dealt with Indian transfer pricing issues for a long time, that relationship has ebb and flow. But certainly, I think kudos to them, both from U.S. APA program, but also India APA program, to give a lot of taxpayers certainty on those transactions. I think those transactions are relatively straightforward, so good to process those. I think we see other transactions, as you were saying, David, that maybe are not as straightforward, and that kind of relates to maybe the IGM. About 2 years ago, the APA program put out some guidance that historically they would accept kind of any and every taxpayer who applied for an APA, but they're going to scrutinize those applications more. And I think we've seen that kind of influence some of the cases that they're taking on. I don't know, Jenny, if you want to give some comments on your experience with that.
Yeah, we've encountered some situations where the APA program has been reluctant or struggling to take into or to address, I'll just say, very complex non-IP transactions. I think they've gotten more comfortable handling IP transactions, but anything out of the norm that's new and novel, it almost seems like their preference would be to have exam beat it up and then have it come back to them as a map and have more facts. I mean, it's very unclear because I'm a litigator, right? Like, I love going into the courtroom. It's not good for my clients, but it's really fun for me. So I want a working, functional, right, MAP and APA program. So that way, the only time, for big transfer pricing fights or in a courtroom is where everything else falls apart. And I really hope that we get, right now, the IRS is kind of dysfunctional. Peter may or may not agree. But I really hope we get back to a point where the staffing up of APMA really was helping move things along, and we all benefit from a functional, competent authority.
Well, to that point, and on the IGM specifically, I am not a litigator. I'm a lover, not a fighter. So I like to get all of these things done in a nice way. Where I get heartburn around the IGM and exactly what you're saying, the kind of reluctance to take on complicated transaction, is if we get into a situation where resources are even further squeezed, will there be an overuse of this? And the problem with these complicated transactions that taxpayers are bringing into competent authority, it's a see me now or see me later. Right, we can deal with it now where there isn't a big sack of money on the table and we can talk about it for a long time and get into the facts. Or we can talk about it after the US or a treaty partner has made a massive adjustment that they're married to, right? It's so much easier to go up to your bosses and say, over the next 5 years, I've secured this amount of revenue, as opposed to, well, we made this adjustment X and we've given away some portion of it. Right, it just makes the discussion tougher. Also, in the APA versus MAP, the taxpayer's an active negotiator, so you can kind of push and pull in there. When you're in MAP, taxpayer's position is what is in the tax return, right? And then the governments have to go back and forth. And if they come back with something taxpayer can't live with, it's back to your world where you're still fighting about it and you don't have the answer.
Yeah, and I think from my perspective, I think everybody's trying to figure out everybody within the IRS, but also on the taxpayer side, is trying to determine how to appropriately allocate their resources. And to me, this is an area where being proactive and providing that certainty, I think, would be better. I can understand from an APA program, they have limited resources, but exam has limited resources. The government on hiring outside experts, that is going to cost a lot. Same on the taxpayer side. And so in my view, dealing with that on a proactive basis would be more appropriate. This has happened more in the minority of cases, so not something to affect most taxpayers, but nevertheless, the ones that it does, effects stringently.
And in many instances, the frustrating part is the taxpayers in some of these more complicated cases is looking for the IRS to be an ally, right? Pushing against some of the more aggressive positions outside of the U.S. and not doing it at the time just creates a massive issue in my.
Well, and the other point I'm starting to see, because in the last few months we have been receiving, I'll just say, egregious statute extension requests. That pushing things out for no reason for for years, and so we are having many conversations that we would not have had even a year ago about what's our best strategy, right? Like, do we just take this big, billion-dollar issue to tax court, perhaps to post-docketed appeals, just to cut it off? Because we're now, right, like 6 years, 7 years, right, that it's never ending. And as tax rate disparity becomes narrower and narrower, right, then maybe I don't care if I'm paying 21% to US and 15% to Ireland, right? It's not that different. But if I'm paying interest on that, differential, maybe I'm better off just going to tax court and proving it out. Again, fun for me, bad for my clients.
And so maybe we'll take a pause here. I think in the interest of time, we're probably going to skip the country-specific matters, but take a pause to see if there's any questions for the audience. If they want to ask about specific countries, we can answer those, or we can talk about just kind of overall controversy trends.
Hi, I appreciate you raising all these points. And by the way, hi, Peter.
Hi, Tom.
I'm a little troubled because I guess the nature of what we've been talking about affects, the largest corporations in the world. That's cool. They have plenty of money. They can have you litigate it. It's a lot of fun. I've experienced a lot of startup companies, a lot of mid-range companies, a lot of companies trying to grow, trying to become companies, and I really haven't seen guidance. Your first example, your first posit of having a key intellectual property, that may be all they have, but what they don't have is the $20 or $30 million that you're talking about to make all this happen. And they're not going to have that available. But there's no guidance across the world. I'm not talking about just the United States, across the world, to allow people to move forward. And it's become so much of a game. I mean, Peter and I go back a very, very long way when it wasn't quite as much of a game. It's become a game, and I'm a little troubled by it. Can you comment on what you think could be available to allow companies around the world to function without having to be the largest companies in the world?
Yeah, maybe I'll comment, but also interested in the panel's thoughts on this too, right? I think we see, again, not just the U.S., but foreign governments focus on issues that's kind of important to their economy, right? So we see like the Nordic countries focus a lot on IP, or Israel, that kind of leaves. We see the U.S. focus on non-U.S. rights that then leave as well, that perhaps erodes their tax base. We see Australia focus on, they're very much an inbound economy, right? So those companies that are doing business in there, what their profit level should be in there. And we see a lot of guidance out there around kind of de facto safe harbors, or like, for example, Australia has this PCG guidance around how much returns they should have, or this Israel circular. But in my view, they're not harmonized, right? So they take kind of, so these sort of safe harbors or these sort of guidance would be helpful for taxpayers, particularly small growing companies that have key IP but no cash flow associated with it, potential big cash flow down the line, which is usually when the IRS gets in, but potentially not, right, as they're making a lot of these investments. And so I think, harmonizing some of those transfer pricing safe harbors would be, excellent. I think that's something that when it comes to the OECD, we've probably seen, movement to try to do that in Pillar 1, Amount B, but no real, in that I know that's not focused on IP, that's just focused on actually the least, supposedly least controversial returns, but no kind of political will from the countries to really commit from that for various reasons. I don't know if others on the panel want to offer their own thoughts.
No, I think I echo a lot of what you said, Kevin. I think it's a difficult position to be in, and I think from a tax risk perspective, the risk might be a bit lower given the profile of the company you've described, and I think that gives the opportunity to kind of look ahead and say, okay, what do I need to put in place as I'm moving forward, right? Because the goal is always to be one of the winners, and when you're one of the winners, what's going on? And what I've seen is dealing with some of these smaller companies that have grown and become successful. They haven't done anything in the interim thinking about tax and thinking about, what does my structure mean from a tax perspective? And I know it's an extra thing for a small growing company that only has a few folks, but I think as Cameron mentioned, kind of looking at the rules, looking around and trying to make sure you have the right advice early on so that the steps you make now don't cause a footfall later.
Any other questions from the audience? If you think of them, let us know.
Trying to stay away from litigation trends, are you?
No. I do want to comment. So, we have about 5 minutes left on litigation trends.
I'm watching the hourglass here. The seconds are ticking down.
I think we put that as the last topic because we could spend an hour on this topic, or we could spend 5 minutes. I think one comment here is we've seen, appeals and taxpayers, perhaps somewhat because of this guidance, less ability to get successful resolution in appeals. I think we've seen, and that timeline grow, we've seen more taxpayers docket cases, and there's some choices there, particularly around penalties, that I think is influencing decisions. I don't know, Jenny, if you want to comment on this, because this is a key trend in thinking through kind of how to resolve controversy.
Yeah, one of the challenges in controversy right now is the complete and total dysfunction, even before the last few months of IRS appeals, and the ability to reach a good resolution with appeals. Historically, we were able to resolve, 90+% of our, even our most complex disputes with appeals somewhere within the client's taxpayer settlement range. And now the conversations we have are, we do not expect to be able to reach a resolution with IRS appeals, but we're going to have to go there because of business decisions, right? The adjustments are so massive. You're going to need to go before your board and your audit committee to say, we have done everything we can to try to resolve this at the administrative levels. So even though that now adds, years onto the dispute, that is 9 times out of 10 why we are going to appeals. Or we're going to appeals to wait and see and hope somebody else fights out our issue. But we are not, very rarely do we go to appeals with the hope and expectation that we are going to reach what we would consider a good resolution of an issue. And what this means, and I saw lots of heads nodding as I mentioned the dysfunction of appeals, is we now have more conversations about docketing cases and, going, either using post-docketed appeals, which if you do that, you run the risk of having contemporaneous discovery, or bypassing appeals altogether and just pushing the issue forward in tax court. And none of this is good for taxpayers or for the administration, right? We need a functional appeals.
No, 100%. As I said before, I leave the fun of the fight to folks like Jenny. That kind of stuff makes me nervous. I'm gentle, and I think folks should have more room to deal with these things. And again, going back to the point of double tax being more important, I think you run the risk with litigation, even if the IRS is successful, you're then stuck with that adjustment. And I think competent authority is limited on the U.S. side to what they can negotiate. And then how do you convince treaty partners to accept that position? So as we look at, tax holistically, the trend of kind of a more aggressive IRS exam, not just from an adjustment standpoint, but the inability or the unwillingness to settle, it makes me really nervous because I think that's just a bad answer for clients.
And I want to echo one comment that Peter had made earlier that plays into litigation too, right? So to the extent that taxpayers are making more reg challenges than seeing the flip side of being asserted with an economic substance, business purpose case. I think that then also drives the case to perhaps have to go to litigation where maybe there could be some sort of other resolution. That does bring us up to times. Please join me in thanking Jenny, David, and Peter for the panel.
Wasn't much on litigation.
Thank you, panel. We'll now be taking a 15-minute break. There are refreshments in the Greenberg Lounge across the way. Please be back here promptly at 11:15 for our keynote address.
All right, welcome back, everybody. I know that we're still making our way back into the room from our break, but I would like to go ahead and get started because we have a fantastic keynote address, and I'd like to go ahead and get moving with that. My name is Brant Hellwig. I'm a member of the tax faculty here at NYU, and I also have the privilege of serving as the faculty director of the graduate tax program. It is my honor to introduce my colleague, David Rosenblum, who is going to deliver our keynote address. And to put it mildly, David is a fixture in international tax circles. He's a longstanding partner at the law firm of Kaplan and Drysdale, where his practice broadly focuses on international tax planning and controversy. From 1977 to 1981, David served as International Tax Counsel and Director of the Office of International Tax Affairs at the Treasury Department. He has served as a tax policy advisor to the OECD, the International Monetary Fund, the World Bank, and a broad range of individual countries. At NYU Law, David is the James S. Eustice Visiting Professor of Taxation, and he also serves as the director of our school's International Tax Program. But that's a program that he has led while holding down his robust legal practice in DC. He has commuted up to New York, and he's led our International Tax Program now for 22 years, which is pretty remarkable. So in the international tax realm, David certainly has seen it all. So we're really fortunate to hear his personal wish list regarding the U.S. tax treatment of cross-border income. So please join me in welcoming David Rosenblum for our address.
All right, thank you very much, Brant, and thanks to KPMG for indulging me, giving me a few minutes to just express a few things that are on my mind. I know some of you in the audience, but a lot of you don't know me, but I've been doing this for a long time. I think you may have noticed the long-standing words used in Brant's introduction. Let's put it this way. My introduction to tax law, the first assignment I had was in working on the Tax Reform Act of 1969. So I've been doing this for a while, and over the years, I've formed some opinions on the U.S. tax system, and I'm going to pretend for the next 30 or 40 minutes that there really will be a continuing U.S. tax system. So we're going to engage in Coleridge's willing suspension of disbelief here, and pretend that things are going to revert to some kind of a norm. And if they do that, here are some thoughts that I had, not in any particular order and not comprehensive, but things that that if I ran the zoo, I would push in this direction. So again, no one thing stands out, but let's start with the statutory law. I mean, I'm in contrast to treaty law, where I'm going to say some things. For reasons that I think we can all understand, when we talk about cross-border taxation in the United States, particularly the United States Congress, the talk tends to focus almost 100% on outbound investment by U.S. Multinational companies. I suppose that's where the money is in a sense, but there's almost no talk about anything else that's cross-border. And the TCJ is a good example of a statute that was focused in its international provisions almost entirely on corporations and entirely on cross-border. I'm hard-pressed to think of too many. I guess the BEAT was originally designed as an inbound measure, but of course that proved not to be true, and it was obviously not true really from the get-go. So one item on my wish list would be for more attention to be paid to the inbound taxation. The rules that are in place on taxing foreign persons on their investments in the United States have not been changed very much since 1966. Some of you might think the world has changed a bit since 1966. We are host to a lot more investment than we were in those basically post-war years. And Congress and some of our commentators are saying, where are we going to get the revenue? Where are we going to get the revenue? Well, I think there's quite a bit of revenue in the inbound side that's going untaxed. And I've never totally understood why our policymakers shy away from that. Not only is it untaxed in the statute, but I think the enforcement, with possible exception of some audits of foreign banks, is pretty low. The effectively connected rules are just not really well pursued in my experience. The other aspect of cross-border that gets no attention is non-corporate cross-border situations, partnerships, individuals, trusts. I would throw into that, although it's a side item, but it's not insignificant, the treatment of possessions income. It may seem insignificant when you're talking about how to tax the Amazons and the Metas and the Googles, but there's a lot of money in those areas, and quite apart from revenue, the major aspects of a functioning tax system. I revert back to David Bradford, one of the really great policy proponents of international tax law. Not a lawyer, but a wonderful book and wonderful comments. He taught me years ago that if you're going to have a good system, you need to have a system that is, obviously efficient in the sense of interfering as little as possible with the choices that people would make in a world without taxation. But also the other two components of a well-functioning tax system besides efficiency are fairness, or at least the perception of fairness, and simplicity. Now, the U.S. the ship has sailed a long time ago on simplicity, although personally I think simplicity is the component that really should go first. But it's really too late to ask for that in the Internal Revenue Code. But fairness, it does seem to me, is something that we ought to be able to do a little better job on. And we've created situations by paying no attention in the cross-border context to non-corporate taxpayers. We've created situations which have allowed some astonishing, to me, evasions of tax, and that can only have a bad effect on the overall implementation of our tax system. So two things that I would put together as statutory changes or statutory developments is more development paid to the inbound world, and then more development paid both outbound and inbound to non-corporate taxpayers. And you might put a sort of a footnote to that. I would spend a fair amount of time, at least today, on the possessions, because what's going on in the possessions today is frankly shocking to this experienced U.S. tax person. I think there ought to be a lot more attention paid there. So those are some of the statutory things that I would change. But my teaching in recent years and a lot of my activity has involved tax treaties. And so I have more thoughts about the tax treaty program, which I think is not in a great shape. And it ought, some real effort should be adopted to put it in much better shape. Tax treaties have one overriding purpose, which is the greatest purpose of treaties, which is that they establish a dispute resolution mechanism in the mutual agreement procedure. So we don't have an international tax court, and as far as I can see, we're not going to have one as far as the eye can see. The other ways of addressing international tax issues aren't very satisfactory. There's a lot of litigants who have recurred to bilateral investment treaties, but I think bilateral investment treaties are a terrible way to resolve tax issues. They're inefficient. They're extremely expensive. I could go on, and I have gone on in writing on this subject. I just think that's a bilateral investment treaty is a way of resolving your basic tax issue that you encounter in cross-border commerce is just not a very sensible way to go. So that really only leaves the mutual agreement procedure, and that's something going into a world, even if the U.S. declines, as I think we will decline, to take any part in Pillar 2. We'll hear more about that later today. We're headed into a world where there are going to be more international controversies. There are going to be more circumstances when taxpayers are going to need to have resolutions of their problems, and I think the only game in town is the mutual agreement procedure and the tax treaties. Now, I have a lot of problems with the way tax treaties are regarded in the United States. How they've been treated. And that's something that has grown on me over the years. Tax treaties, of course, are the supreme law of the land. We know that from the U.S. Constitution. They have an equal status with statutes. But I don't think you have to look very far to reach the conclusion that Congress regularly forgets about the tax treaties. It enacted the Tax Cuts and Jobs Act without taking account of tax treaties. Perhaps that was required because of the reconciliation procedure. I suspect it was. But in any event, there's a mild flavor of illegitimacy of tax treaties when you talk about them on Capitol Hill. And I think that's bad in all sorts of ways. First of all, the treaties are there, and they are a commitment of two countries. Almost all our treaties, virtually all our treaties are bilateral. And secondly, we could be using treaties a lot more effectively with our cross-border policies. I think other countries have a much more intelligent use of the synergy that can be achieved by combining statutory law with treaty policy. For some reason, partly because of the way treaties are handled in Congress, the the House of Representatives has no role in the adoption of a treaty, and the Senate basically has the role of being sort of a gatekeeper, a yes-no role, as opposed to negotiating. And so you get to a situation where Congress basically looks askance at treaties, when I think treaties could be integrated much, much better into the fabric of the U.S. tax policy. And then another aspect of this is, although we have, by my count, at least 3 and maybe 4 sets of weapons that we use to defend against treaty shopping, the illegitimate use of treaties to reduce the U.S. tax base, I'm not convinced that the Revenue Service has been very serious in applying those rules. And it does seem to me that, particularly with the advent of 77010 in economic substance, which I thought right from the start presented a 4th quite powerful tool in the area of tax treaty shopping, we have yet to see anything come out of that. And I've had experience in cases, both in cases where I've served as counsel and in many cases where I've served as an expert witness, where I have been really surprised at the amount of treaty shopping that still is used, that prior to the term much wanted termination of the Hungarian Treaty, which was just a catalyst for all sorts of treaty shopping. Treaty, by the way, that I negotiated. That's another whole story. But the Hungarian Treaty just was turned into an invitation. Who knew that the Hungarians would turn themselves into a tax haven? And the Revenue Service had opportunities to counter that kind of planning. And I saw a number of situations on the ground where the service simply looked the other way and accepted what I thought was pretty blatant treaty shopping. So I think the whole treaty program, which has fallen into a sort of a dark hole ever since the early 2000s, ought to be amplified. There ought to be more resources put into it. Somebody ought to really attempt to figure out what Senator Paul really wants. I tried at one point. I mean, it's a little. We actually had a program here where we had his representatives come try to explain. If only he would explain whether his concern is. Whether he's more concerned about getting information or giving information, that would help. But I assume that one could work with him to get treaties through the process and get them ratified. And the U.S. model treaty, as it exists today, which is from 2016, there ought to be a new model, and I keep hearing that they're working on one. What we work with when I teach this course today as a model is, believe it or not, the U.S. treaty with Croatia, which is basically almost word for word the 2016 model, with just a few changes which were doubtless put in there by the United States. So I'm not sure where U.S. treaty policy is today, but it does seem to me that our model, which has been very favorable to residence countries, we insist on seeing ourselves as almost uniquely a country where residence taxation should prevail. That ought to be changed. This goes hand in glove with my thought that we ought to be spending more time beefing up, simplifying, streamlining, and putting a little more substance into the inbound statutory rules, we ought to be moving, in my judgment, away from this exclusive reliance on residence taxation. We're more residence oriented than the OECD, which is saying something. And so I would have said I was disappointed that our model went along with its prior orientation in the grand conflict between country of source and country of residence, of favoring the country of residence again and again and again. I think that ought to be rethought and changed. So three of the things, you've heard some of the things that I would do. Now I'm going to venture a little bit more, just as a thought experiment. Robert Scarborough, whom I was talking with about on this subject just a few minutes ago, suggested a thought experiment. I like that idea. One of the other things I would do is I would cut down vastly on regulations. I think tax regulations are largely unneeded. There's a lot of regulations that simply parrot the words of the statute. I don't see the purpose of repeating the words of the statute in the regulations. But beyond that, I think I came to this because I spent a good deal of time with the cost-sharing regulations and what they have done. And I did do an article with a colleague from my law firm calling the cost-sharing regulations the original sin, because they are, to my way of thinking, at the genesis of a lot of the problems that we have seen in outbound taxation. Our cost-sharing regulations were not simply a way of sharing the cost of doing certain things, but they morphed sometime in the 1990s into a way of expatriating intangible property. So if you scratch the surface of a lot of the controversies that we've seen, for example, the state aid litigation against Apple, that's the origin of that problem is cost sharing. Neither side wanted to make much of it in the litigation, but Apple couldn't have earned all of that income abroad, and of course subject to a very low tax, without the transfer of intangible property into these Irish subsidiaries, where they could be used to earn foreign income without any involvement of the U.S. tax system. Cost sharing to me was really misapplied from the start. It was thought to be part of the arm's length system. That our cost share was simply what people did at arm's length, which I think is manifestly untrue. And partly because of some economists said this was a great idea, and the Revenue Service, which tends to take these ideas like arm's length and turn them into religious concepts, and and expand them and polish them and continue to write more rules on them. It turned into a situation where we lost huge amounts of revenue from our tax base, and then that produced GILTI, that produced BEAT, that produced an awful lot of the anti-abuse rules that we saw in the TCJA, and as I say, state aid litigation, and also I think it's the origin of the BEPS project. I think that the reaction that the United States has had in the international tax context from the rest of the world is largely because what we told the world in simple terms: residence-based taxation is great. It's much better than source taxation. We'll do it. We'll do the residence-based taxation. Then we decline to tax our companies on the basis of residence. And I understand there are political reasons for all of this. I'm not naive. But we turned, the cost-sharing rules turned us into international tax hypocrites, saying that we would tax these companies when we didn't do it. And so you get Margaret Vestager coming in and saying, well, if the United States isn't going to tax it, we will. And that's the Apple case. So here's the thought experiment, which Robert and I had a brief conversation, which echoed what I was going to say, which is this. I am of the view, contrary to what some people said earlier this morning, that the many regulations ought to go, and a good thought experiment would be in the area of transfer pricing. I am wondering what exactly is wrong with the statute. In other words, we have a statute, Section 482, which doesn't mention arm's length method. And we've got reams of regulations that are built on that statute. My general sense is that those regulations have not favored the government, that they have basically been not very helpful to the resolution of the hardest disputes. The easy disputes, I think we could resolve, but the regulations pretend that the arm's length method is something fixed and immutable, or at least achievable. And I think in the case of intangibles which don't exist between transfers of intangible property that don't exist between unrelated parties, I think that's not true. So we've tried as hard as we can to come up with some kind of an ersatz approximation of what we think of as arm's length method. And my sense is that hasn't been very helpful to the government. I'm not sure it's worked terribly well. So this is supposed to be my wish list, and this is, I think, my final wish, which is if I were in charge of this situation, if I ran the zoo, I would be inclined to take a very hard look at whether we need any regulations implementing Section 482, any regulations at all. I would not, I think, discard the arm's length method as a goal, an aspiration in a given dispute. But the idea of writing thousands, hundreds of pages anyway, maybe thousands of pages about something which in the hard cases really doesn't exist, strikes me as having been an exercise in futility. And more, what's really to the point, what really impresses me, I think it's disadvantaged the government. I think we would have done much better arguing in most cases with very few regulations, if any, on the basis of the statute, and letting the matters go into court on whether there has been an abuse in accordance with the statutory terms, and let the courts eventually iron out a set of standards. And I suspect arm's length would be among those standards, but it wouldn't occupy the prime place that the regulations have given it. The case where that I came to that conclusion, or at least to that realization, was Xilinx, which was very poorly litigated and very wrongly decided. And the idea was that somehow there was an arm's length transfer of Crown intangibles, which I just don't think that exists in the wild. So that's another thing that I would do. I would cut, and my point on regulations goes beyond transfer pricing regulations. Although I've worked mostly on the cost sharing, I do think that where we are with all of these volumes of text, a lot of that seems to me to be quite superfluous. I would favor simpler view. I realize the code, we can't do much on the code, and I realize there is a need for guidance in some places. I'm not crazy enough to suggest abandoning all regulations, but I think it would make sense to try to cut way down on the words that we put out. What we're trying to do, what we've tried to do in the United States, is to describe economic activity in words, and I think that's a mad enterprise. I just don't think that's possible, and we keep on chasing our tail. And you know, when I started in this business, way back when, I would go into a classroom, and I'd have the Internal Revenue Code in one hand and the Constitution in the other, and I'd ask the students, what is the real Constitution of the United States? Sure. I mean, if you're concerned, if you're really eager to start burning the American flag, or you're desperate to spend your time viewing pornography, Constitution's for you. But if you want to know where you're going to live and where your children are going to go to school, and I think the other volume is a lot more relevant on a daily basis. Now, you know, I can't do that anymore because the code is too heavy to log into the classroom. But I'm in the pantheon of desiderata for a good tax system of efficiency, fairness, and simplicity. I'm all for simplicity, and that would be the very head of my wish list. And so that's what I wanted to say to you. I think I've spent as much time as I can reasonably take with my wish list, but I'd be happy to answer any questions. I'm sure there are people who think that what I say is wrong. Yeah, Mike.
If you didn't have a lot of regs, like 482 is a good example, every taxpayer would take every possible pro-taxpayer position with reasonable basis, probably, if it's a plausible interpretation. At least, and there's not going to be a lot of IRS agents to challenge every taxpayer. And so you're going to have a giant revenue loss, I think. At least, look, the regs aren't perfect now, but they at least have some guardrails.
I guess my reaction to that is that would last until you got some, if the courts played a law, if the courts followed the statute and upheld the government with severe penalties, the penalties aren't going away. I'm not so sure that you would face that problem. I mean, initially people would take pro-taxpayer positions. I'm not so certain that. I'm not as afraid of that as you are. Moreover, I'm not sure that's not the case now to the extent. The regulations don't really, first of all, the regulations don't speak to a taxpayer, the 482 regulations. The statute doesn't speak to the taxpayer. The statute is addressed to the Revenue Service. So I don't see anything in the 482 regulations that prevent taxpayers from taking any position. Actually, I had occasion to deal with the question, you might have a view on this, as to whether it's possible to have a criminal transfer pricing case. And my view is that it's not. There's nothing in the statute that says you have to charge at arm's length of price. What the statute says with the regulations is that if you don't charge at arm's length price, the government is entitled to come in and make an adjustment. But there's nothing that tells the taxpayer what it has to do. Now, there may be other criminal statutes that would, in certain circumstances, be violated, but there's nothing that requires you to charge any particular price in 482. It doesn't even speak to you. It doesn't speak to the taxpayer.
Like, well, maybe the rest of the code would have that problem. And you have also, if you have a reasonable basis, there's no penalty, so people could be pretty aggressive. And it would be years before you got all these court cases.
No, you don't need all these court cases. What you need is a limited number of court cases with robust decisions, and I think taxpayers would get the result. You know, this goes back to something that ties in. First of all, in the real world, I don't think that the U.S. multinationals are really audited efficiently by the Internal Revenue Service. Where they're audited is by KPMG. They're audited by the accounting firms, and that's not going to change. I mean, because there's risks outside challenges just on tax grounds if companies take positions that are too far out of line. There's stockholder suits and things like that. I'm not convinced that the regulations stop, at least the 482 regulations stop what you're talking about at all.
Right, but at least in the rest of the code, if you have negative regs, at least it prevents KPMG from giving favorable opinions that they might be able to give under the code itself.
I have an idea. I'm not sure. You really think the regs are doing that? I'm not convinced that they're serving that function. But in any event, even if they are, I'm not necessarily saying abolish all regulations. I'm saying take a hard look at the regulation. We've gone in the last 20, 30 years from pretty robust and large volumes of regulations to these mammoth tomes. No other country in the world has done that. Surely the way we have proceeded is not the only way to proceed, to have a tax system. Other countries seem to function with their tax systems with a lot simpler rules and a lot fewer pages of text. And I think part of it, actually, which might answer your question, is to endow those people in the Revenue Service who are doing examination with greater discretion, which is one of the things we've been deathly afraid of. So what's happened, my perception as to what's happened, is that because we've wanted to circumscribe the amount of discretion in the agents, we've tried to give guidance. But since the business world, the economic world is constantly evolving, we're always playing catch up. It's this constant catch up which has produced these mammoth regulatory volumes. That can't be the right way to go about it. It just doesn't seem right.
Just one more point, then I'll stop. But other countries have anti-abuse rules, general anti-abuse rules that we don't have. We have Loper-Bright that says you have to follow the literal language of the statute, even if it makes no sense. So it may not be comparable with other countries.
I think 77010 is essentially a general anti-abuse rule. We could have that debate, but I think that's essentially what it is, and I think that's essentially what it was designed to be. So, and I think it ought to be applied in the cross-border context. As I said, I think it's a potent weapon against treaty shopping, which, as far as I can tell, the Revenue Service has never used. One of the problems with a lot of this stuff in the regulations is there seems to be a substantial disconnect between what the people in Washington are putting into regulations and what the field is actually using. There's a lot of circumstances where the field seems hesitant to use authority that they plainly have. I remember that going back all the way to the time when I was in the Treasury. The service is not very bold in using authority that it has been given either in the statute or other regulations. So I don't see that eliminating the regulations or at least cutting them way down would pose the kind of problem you're suggesting, and I actually think it might go in the opposite direction. You'd have simpler regulations that could be understood by everyone. That's my view. Yeah, Kim.
Thank you. This is just a quick question, but in the beginning of your remarks, you mentioned that we could look at taxing more inbound transactions, and you specifically mentioned ECI, that you thought people were not paying tax on ECI. You know, back in the beginning, before some of the specific code sections I'm about to mention, I think that was a real issue. But now we have, you know, for partnerships, we have mandatory withholding under 1446. You know, we have FERPTA withholding, we have ECI in the sale of a partnership withholding. So there's a lot of ECI in the system is subject to withholding, and my impression is that those rules are not ignored. So if that's right, then there's this sort of piece of ECI, which is earned directly, right, through a branch, that you're thinking is not taxed. And I just wondered if you could elaborate on that and give some examples, because that did surprise me.
Well, there are a number of things that occur to me. First of all, I think you're talking about ECI. Let's go back to trade or business. We don't get to ECI unless we have a trade or business. I think that the rules on trade or business, they're very hard to write, but they're primitive. They're made up of a bunch of rulings that the Revenue Service has issued over the years. I think there's a ton of trade or business being conducted in the United States that goes untaxed. I think it's very common for foreign companies and people to come into the United States. And it may be that our trade or business rules are too low. I mean, it's too low a hurdle, but it is a low hurdle. And I just don't think it's being enforced at all. On the ECI front, I've never understood why we shied away, even in 1966, from taxing foreign source income. I mean, the ECI rules work with respect to U.S. source income, but for foreign source income, they don't work at all. You can set up a branch, an example I use teaching, you could set up a branch to run a business, say in Miami, and send all your people down to do, I don't know, architectural work or something in South America, and you're not taxed at all. I mean, there's no U.S. tax on the foreign source income. That's a ludicrous result, and I don't understand the purpose of it. And there are other aspects of those rules that I think could be simplified. I don't think they're very well understood. They're really quite complicated. One of the issues that keeps popping up in this area, which I've raised this many times with people, I get all sorts of different answers on this, is what it means that if you have a trade or business in the United States and independently you trade stocks in the United States and it would be under the 864B rules for exemption from trade or business, are you taxable potentially? There's also effectively connected issue there, but are you taxable on those trades, on those market trades? In other words, I've always thought that the statute, and this is just the way I read the statute says engaged in trade or business. It doesn't say engaged in a trade or business. So I have always thought you're either in a trade or business or not in a trade or business. And if you're in a trade or business, then the 864B rules are irrelevant, because what they do is they prevent you from having a trade or business by trading in stocks. But if you're already in a trade or business, my reading is that they don't have any authority. They're irrelevant. They prevent you from having a trade or business in stocks if that's all you're doing. But if you're otherwise in a trade or business, I think those rules don't go anywhere. And I know there's going to be differences in this room on that interpretation. That's pretty basic. That's been around since 1966, and it comes up all the time. I see that a lot. And that ties in with other things I said, particularly with respect to the possession. So I do think very few agents that I've seen are really on top of the effectively connected rules. They really don't understand them very well. I see lots and lots of issues in the application of the agency rule, the attribution of profits to an office of an agent, the 864 C5 rules, which are imported into 865. All of those rules, I think, could use a thorough review, frankly. And I think there would be a lot of income to. And frankly, if we change the treaties, which prevent us from taxing, if we change the rules, we'd actually get some revenue out of this. I don't understand why Congress says, oh my goodness, how are we going to squeeze more money out of the poor U.S. multinationals when they've got the inbound stuff, which they haven't touched for 60 years? I don't understand that. So thank you for your attention. As the late belated Mort Sahl says, the future lies ahead. So.